Good morning, and thank you for joining KBRA's BDC Performance Update and 2025 Outlook webinar. While all attendees have joined in listen-only mode, we encourage you to engage with our speakers through the Q&A feature on your control panel. Ratings and additional research, including our latest Business Development Compendium report, can be accessed through the QR code on your screen. A forward schedule of KBRA's upcoming hosted events and conference participation is available on our website at kbra.com. Should you have any additional questions on the topics discussed today, we are always available for a follow-up call. Now, I'd like to hand things over to our moderator, Joe Scott, for introductions.
Oh, thank you very much, Michelle, and welcome to KBRA's latest BDC webinar, and thanks everyone for attending. I'm Joe Scott. I head up the financial institutions team at KBRA, and we rate over 300 financial institutions, including 34 BDCs. With me today is Terry Seelig, who leads our coverage of the BDC sector. In addition, we have Kevin Kent, who focuses on BDC coverage as well. And we'll start with Terry today. What should we think about in the current environment with the increased market volatility? Oh, you need to microphone.
Sorry about that. Yes, that's a great question. I think it's top of mind for investors. We hope that we'll be able to clarify some of this uncertainty and how it relates to the BD sector this morning. I would stress that BDCs have been mandated. They mostly originate loans to U.S. middle market companies and primarily in the services industry. So they have limited exposure right now directly tied to the global markets. The companies are sponsored back with lots of private equity support and in general to less cyclical industries. However, we are monitoring the secondary and tertiary impacts of tariffs. As you know, and we've been putting out on our BDC compendiums, that credit quality has remained solid over the last several years. We're in a long cycle of benign credit. So the BDCs really start from a position of strength when it comes to credit quality. Our rated universe of BDCs have very low non-accruals at 1.9% at cost at year end and less than 1% at fair value. And it stayed relatively stable in the fourth quarter with very few non-accruals added. There were some high-profile exits and restructurings, but besides for that, we've seen pretty much a stable asset quality. The portfolios are very diverse by industry, subsectors, and portfolio companies, name by name. BDCs try to diversify of having having names less than 3% of total investments and more toward the 1%. And this is super important in uncertain economic times as we have today is diversity, portfolio diversification. And as I mentioned, the BDCs are really focused on non-cyclical industries, mostly in service. And the three top are usually computer software, business services, and healthcare. And for the computers and high tech, it's usually mission critical businesses. So we would expect that these services to a company would reduce these expenses last to maintain their competitive positions. So we feel pretty good about the industries that the BDCs lend to. And also, as I mentioned, US based, not as, certainly they are not as exposed to like supply chains. But that said, we are definitely looking at the indirect effects that could emerge as end users of services of supply chains are impacted over time. So that would be a secondary or tertiary. And if we were to enter a recession, which the probability of a recession has been slowly increasing, we feel that there is obviously some downside exposure, even though they are in these less cyclical industries. So we would expect to see higher default rates, but definitely within manageable levels, in the context of the BDCs have extremely low leverage.
Yeah, thanks, Terry. And then on the topic of leverage, how does the leverage look for the sector currently?
Yeah, sure, Joe. I mean, the leverage for the BDCs are very low. Even though, regulatory minimum requirements allow them to have 2-to-1 leverage, the BDCs have maintained very low leverage over the years, and especially now. Our universe stands at only 1.06 times leverage, which is really low. A lot of that has to do with a very muted transaction volumes in mergers and acquisitions and leverage buyout. So demand for loans is relatively low right now, and especially in comparison with the amount of capital that has been raised in the private credit markets over the past couple of years. A lot of that capital has been raised by perpetual life BDCs. We currently rate 13 of them, both published and unpublished, and they raised equity of about $20 billion in 2024. And these BDCs are raising equity in the markets monthly. So there's just been a flood of capital and muted transactions, and that's still pretty uncertain as to where that will be in 2025. But on the positive side is they've raised a lot of capital, but they're still very measured in how they underwrite the BDCs. So we believe that they are deploying capital very conservatively, and therefore hold a lot of more liquid level 2 assets, which we'll talk about next, but are not chasing deals just to add to their portfolio, which we feel will be very beneficial, especially in tougher markets. The low leverage, really puts them in a good position to absorb, any fair market value adjustments if credit conditions worsen.
Yeah, and let's delve into that a bit on fair market value adjustments and the possible effect of that with wider credit spreads in the market currently.
Yeah, another really good question, and something that we've looked at extensively is how BDCs value their assets, because they're level 3 with not a lot of market inputs. So because they are required to mark their books every quarter, we've really looked at it. So while spreads can widen considerably, they do not automatically flow through to the portfolio company valuations. So, we've even, spoken with these third-party valuation companies, especially in 2020, when spreads widened 1,000 basis points, and talk through with how these valuations were going to impact the BDCs. And when they look at them, although they do consider interest rates, they're really a thoughtful analysis and reviewing the company's financials and looking for any marked changes to their operations rather than just interest spreads. So looking to see how the company's operations will be impacted rather than any, spike in, interest rates, or whether that's just market reaction. So that's reassuring. So as I mentioned before, a lot of the perpetual lives have portfolios of broadly syndicated loans, and those assets, or more liquid assets, are classified as level 2, and they do have tradable markets. So they're more impacted by quarterly valuations. So because there's have had such excessive capital raised, perpetual life BDCs have invested in BSLs. So we do expect that NAV volatility will be slightly higher than portfolios that just have level 3 assets. About usually 10 to 15% of the assets are in these more liquid assets. But on the flip side, we feel comfortable with it because right now the perpetual life BDCs have extremely low leverage, even lower than our non-perpetuals. So at less than 1 times for our portfolio published, it's like 0.8 times. So they can easily absorb a lot of volatility for NAV with this low leverage. In fact, we took the entire portfolio and we stressed the investment portfolio at considerable levels and still found that our universe of BDCs had adequate asset coverage cushions. The cushions went from 29% to 16% was the median. So 16% still is pretty good after stressing the portfolios. And then for perpetuals, it was even higher. So feel very comfortable with some market volatility in revaluing portfolios given the extremely low leverage.
Yeah, some great insights, Terry. And then going on to earnings, how have earnings held up to date? And then what do you expect as 2025 unfolds? Will there be the need to cut dividends at some point at the BDCs?
Right. Yeah, that's also a very good question and very top of mind. I know from investors, I got a lot of questions on that. What's happening, with earnings of BDCs, and rightly so. Because there's a lot going on right now. And one, earnings have been pressured. The net investment income has declined. One, because just simply rates have declined in 2024, and then also the increased competition from all this excess capital. So a lot of BDCs have had to reprice assets to stay competitive, maintain their portfolios, and then when they originate new loans, a lot more competition. So we've seen spreads, go down, about 475. We've even seen it lower, especially on the upper middle market tier loans. And that 2 years ago was over 600 basis points. So a lot of compression there. So definitely is impacting net investment income. Well, right now, we've seen a few dividend cuts in 2020 in the just recently announced, and I think that's in anticipation of further rate cuts and different environment going forward and more competitive. But the BDCs that have been operating for a number of years had not paid out this excess net investment income over the years, have paid it out in special dividends. So we assume that the base dividend would stay relatively stable and the special dividends will begin to be cut. But more importantly, we feel the BDC interest coverage from a BDC standpoint is robust and can easily cover interest payments without asset sales. So we feel very comfortable about that. We do, as a RIC, BDCs must pay out 90% of their earnings. So we don't view the earnings as something that will be adding capital to the BDC because it's all paid out. So more for investors that are looking at the yield.
Thanks, Terry. And then we'll move on to Kevin. How do BDCs look from a liquidity perspective?
Yeah, liquidity was solid heading into 2025. As of year-end 2024, our rated BDCs had excess liquidity between cash and credit line availability, more than enough to cover near-term maturities and unfunded commitments. Plus, many BDCs continue to raise substantial substantial equity each quarter or have unfunded equity commitments available. And among the perpetual life BDCs, we're seeing a good portion of their portfolios, as Terry mentioned, invested in these more liquid, broadly syndicated loans, which help support liquidity even further. Though, as Terry also mentioned, they are more impacted by valuation adjustments given market inputs. With respect to KBRA's 13 perpetual life BDCs that we rate, in 2024, as Terry mentioned, they issued around $20 billion in equity, with only about $1.3 billion in share repurchases. So, that's a net equity raise of almost $19 billion. So clearly we're seeing substantial demand from investors for these perpetual life BDC structures. 2024 saw a significant amount of unsecured note issuances among our rated BDCs, about $10 billion last year. As these funds issue more unsecured debt, they unencumber assets, which provides more financial flexibility. Some of these issuances were for new debt, but much of it was for proactive refinancing of upcoming maturities. Looking ahead from April 1st, BDCs in our rated portfolio have only about $2.3 billion in maturities remaining in 2025, but that does ramp up to about $8.4 billion in 2026. So it's good to see the proactivity in addressing these near-term maturities. So given that context, during the first quarter of 2025, our rated BDCs issued about $2.4 billion in unsecured notes. And that's roughly the same annualized pace as 2024. Of course, unsecured debt is usually fixed rate debt. And in the current rate environment, BDCs are often, not always, but they're often using swaps to achieve a floating rate risk profile. So we're seeing that. Also during 2024, we continued to see greater diversification in funding sources, more secured credit facilities with greater capacity, increased unsecured issuances, and a slowly growing use of secured structures like CLOs and ABLs, which creates less reliance on bank credit facilities, which is good to see. Given recent earnings pressure from decreased base rates and narrowing spreads, management teams are focusing on efficient liability management, with some funds opting to replace or likely opting to replace some unsecured debt with these secured financing structures that often notably have better pricing. Many management teams are also closely watching the unsecured markets for an attractive entry point, and they're doing that so they can increase their usage of unsecured debt with better pricing. So that's really the rundown of what we saw in 2024 and what we're seeing on funding and liquidity in the BDC space. Across the portfolio, there is plenty of liquidity and solid access to the capital markets, in addition to substantial investor demand, particularly for equity and perpetual life model.
Yeah, thanks, Kevin. Much appreciated. Now, why don't we move on to some investor questions? We have some really good ones that have come in. And one is about a question on the real default rates. We know the nominal rates of defaults and non-accruals are quite low, as Terry articulated. But if you include the amendments and so forth, the investor was looking for a sense of the real default rate, the real non-accrual rate, the real problem loan rate. So I think we'll start with Terry on that one.
Thanks, Joe. Good question. There's been a lot of talk about the usage of PIK. And in speaking with the BDCs, there's a lot of conversation around the usage of PIK. And especially in this market environment, PIK has been used at origination from a competitive standpoint, but doesn't necessarily mean that it will be utilized. And there's usually a toggle within 18 months to 2 years where it needs to transition to EBITDA loan. As far as amendments, we're finding that when we look at the PIK income, we are being told by BDCs that the vast majority of it was underwritten as PIK loans rather than restructured loans. In I know, there have been some amendments, and we talked to BDCs, and it seems that there always have been, and then hasn't been yet an increase in the amount or the volume of requests, but they definitely do use the covenants to get ahead of it. So there might be even prior, a lot of names are put on the watch list, and if they do see any problems arising, BDCs will get ahead of it before it even is a requirement. So I think, pretty good shape. We also look at the internal credit ratings. Usually that's in their SEC filings and are internally rated from 1 to 4. And to look at that, basically a company, a BDC will look at their loans to see if they are performing below origination, at origination, or above. And then that usually will follow with the watch list. And we haven't seen a lot of negative, if any, migration to the performance below origination. So that gives us some comfort in looking at the portfolio.
Yeah, some great color there, Terry. And then another question, really good. A view on BDC portfolio size and how significant a factor it is in regards to ratings. And then also a general outlook for rating downgrades versus upgrades in the current environment.
Sure. Scale matters definitely from this, how competitive the environment is. And a large part of our analysis really looks at the advisor, the asset manager, and how it's integrated into the BDCs. The BDCs have SEC exemptive relief to co-invest. So when you're looking at, sourcing, research, workouts, relationships, a lot of those advantages come from these huge platforms, and BDCs sometimes just represent a very small percentage of the private credit assets that are going into that particular vehicle. But we look at it in its entirety, the entire ecosystem, which has to offer huge advantages, we believe, to some of the, the smaller players that might not have those resources. So I think scale is critical, and especially in this very competitive environment. As far as our outlook, we pretty much have a stable outlook, but we are monitoring, as we've been saying, looking at this very volatile, uncertain environment with tariffs, interest rates, recession. There's a lot going on, but we do believe that the BDCs, as we've mentioned, really low leverage, high quality balance sheets, plenty of liquidity, lots of resources. So we feel really good about the industry and its ability to absorb, potential more non-accruals and some market volatility. So right now, I would say we're more unstable. We did upgrade a few BDCs last year that had strong track records, had sizable platforms, lots of resources, turned around their, if it was their non-accruals, good plans in place. The other thing I should mention is that when we look at the BDC portfolios this year, more and more are increasing the percentage of first lien senior secured, which is at the top of the capital structure. And that's also good to see, because if there are problems, they have higher recoveries as well. So we're feeling, pretty good in this unstable market, bearing any great recession. We really do feel that BDCs are coming into 2025 with really solid credit metrics.
Thank you, Terry. And then what's the likelihood that increased competition from the syndicated loan market, and that can ebb and flow, of course, cause the larger BDCs to go down market, so to speak, lend more to smaller to mid-market companies?
Yeah, that's a really good question. We haven't seen BDCs really strategically change their, their focus from upper middle market companies to lower middle market or core middle market. They really have teams in place, and their specialty and what they've been doing for years, is focus. Some of the larger BDCs that have always originated across the broad spectrum are continuing, and they do get more favorable spreads in the lower middle market and somewhat in the core, although that's pretty competitive too. So not really a lot of strategic shift there. I would say, the BSLs have put a lot of pressure. That's the broadly syndicated market. So a lot of BDCs in the upper middle market have had to reprice to be able to hold on to those loans. So that definitely affects net interest investment income. But at the same time, a lot of these larger companies prefer working in the private markets just for transparency. It's easier to work with a limited amount of lenders, and also the ability and knowing that they'll get funding. It's just the speed of the transaction, and also if it's bespoke and working through, it's a lot easier with a limited amount of lenders. So private credit market is doing really well. And the other thing is, when there's uncertain markets, we've seen, the BSL market completely dried up. So it's not as reliant as some of the, as the private credit market. So I think, given all this uncertainty, it may work to the advantage of the private credit lenders as well.
Yeah, and just to echo that a bit, there's been recent indications that the banks may be backing off with all the uncertainties in the market currently. And then there's a question here, and we touched on this before, on dividend yields of BDCs and the sustainability of those yields. With the sell-off in the equities, obviously dividend yields in the market have risen, but what we're saying and indicating is there could be some pressure on dividends going forward because of if the Fed moves on interest rates over time and reduces interest rates over time, the BDCs are asset sensitive because of the floating rate loan book. So maybe just touch on that a bit more. I think they'd be under some pressure going into the next year, but at the same time, cash flow and interest coverage of the rated debt would be quite strong.
Yeah, no, I mean, it is something that we're, like I mentioned, that we're getting a lot of questions on. And I think, that is why, as Kevin had mentioned, that the BDCs are laser focused on liability management. So, in 2020, 2021, when rates were 0 and BDCs were funding at 3 and 4%, those days are gone. So there was 3 to 4% funding, and you got spreads at 600, 650. Now you're coming into the market and funding at 6-7%, and you're originating with a spread of 475. So game definitely has changed, and it's not as positive. If the Fed does cut rates, it does pressure earnings because it's asset sensitive, especially if you have to finance at a higher rate. That's therefore the swaps. But the book of assets usually gets repriced quicker than the liability side. So sometimes you'll see pressure, short term on the spreads, just due to the repricing. But BDCs, as we had mentioned, have been very cautious coming into the unsecured market and swapping should rates decline. So we are hearing in conversations liability management. So
yeah, and also it seems as though, from what Kevin was saying, the BDCs have gotten ahead of their 2025 maturities. They have diverse bank revolving credit facilities with ample capacity. So they're well positioned for a more difficult funding environment if this persists. if the market uncertainties persist. But I'd like to thank everyone. That's the conclusion of the BDC webinar. And many thanks to everyone for their time today. And then also, I'd like to point out that you can check out all our recent private credit research published late last week, today, on various sectors of the private credit world, including updates on BDCs, asset managers, CLOs, funds, corporates, and then a broader piece on structured finance in general that's all available on KBRA's website. So again, thanks everyone today, and any follow-up questions, don't hesitate to reach out to the team.